Well, I think it's time to start, otherwise we run over more. Welcome, everyone. Thank you for joining today's session, for staying in the room, and welcome also those who are joining us online. This session is convened by CGIAR and IFPRI, and it's about prioritizing financing for transforming food system. I'm happy to see that actually a lot of you are interested in this topic. And to start with, I would like to give a warm welcome to our two keynote speakers. Jos Wienen is the director of IFPRI, and let me see if I can channel the pronunciation. Lita Majinga is the president and CEO of South African Agricultural Research Council. Jo, the floor is yours. Go ahead. Thank you.
Thanks very much, Debbie. Good afternoon, everybody. I'm really pleased to be here. This is a very important conference, obviously, particularly at the time where we are today, and we hope that the session also today, I think, is addressing for us and for the world a really important topic as well going forward. We are really in a very special moment. It's sometimes you say we are experiencing history. In a way, every moment in your life is experiencing. Sorry, seems to be a difficult word to pronounce. Experiencing history, but this one seems to be special, even in that perspective. I think we are witnessing a major change in our finance architecture for agriculture and food systems. In basically looking back for the past 50 years, I think the next 50 years will be quite different. Okay, and the question is the challenges that we're facing today, how we can deal with them, but also there may also be opportunities that we have today because of all the changes that are taking place. And can we basically make use of these opportunities, grab them, and also steer them in a certain direction? I think a lot of what we will be discussing here today is about that. So I'm just going to raise a few points as introduction, and I think the keynotes are really the people who come after me and go in depth in some of the issues. First point also I want to make is that despite all the challenges that we're facing, I mean, the status quo as we have it, the way the funding is working in our food system is really not leading us to where we need to go. We've seen major reversal in the reduction in hunger, in the reduction in food insecurity, malnutrition, which was tremendous gains from roughly 1970 till 2015. But over the past decades, there's been a tremendous reversal, and of course we know that the sustainability, which is in addition to the hunger problems, the malnutrition problem, is making it even more challenging. So the question is, can we use the occasion, the changes that are taking place now to basically make important changes and be stronger going forward for the future? We'll go through just to give you a feeling about lots has changed already. If you look over the past 25 years, okay, then we've seen that basically total investments, for example, in agricultural R&D and innovation systems, public investment has flattened out in the world over the last 15 years, and that is being correlated with basically also actually a slowing of growth and productivity growth, sustainable productivity growth in the world. But at the same time, we've seen a massive shift both within the public funding from the traditional donor countries, okay, and investor countries, mostly in North America and in Europe, to emerging countries. I mean, China is now not only the country which is has the biggest farm subsidy program in the world, but it's also the biggest investor in agriculture, food, R&D and innovation systems in the world. We've seen very significant growth in other emerging countries like India, Brazil, etc. We've seen also basically as the public investments in most of the traditional donor countries has flattened out, we've seen an uptake very much of the private sector investments in innovation systems. Okay, and they have now, for example, in the US, the private sector investments in R&D and innovation are now double the public sector ones, which is very different 20 years ago. Okay. What about Africa? Well, this is where most of the hunger and the malnutrition problem still is, and we see that Africa is lagging in a number of ways. It is still significantly underinvesting from the public sector perspective, even for its own targets that he had set at roughly 1% of ag GDP. And so only, I think, 15 to 20% of the countries are reaching that target. What is interesting, though, is that if you look at the financial sector in Africa, it's doing quite well, okay? The point is that the investments from the financial sector into the real economy is not working that well. And so I think an important issue for us is to discuss how can we make this work. And so this also relates, for example, you look at climate change and basic climate finance. There we see roughly 4% of all the climate finance in the world goes to agriculture and food systems, okay, which is completely disproportionate with the problems associated in terms of biodiversity loss, water use, greenhouse gas emissions to agriculture and food. And so clearly, why is that? Okay, how can we make that more proportionate? What can we do in order to develop systems such that basically more finance is flowing into the food systems? And part of it are public sector investment, but the big thing is how can we have the private sector play a more active role in doing this? I mean, also if you look again historically, 25 years ago, the private sector is much more dominant now than it used to be. There's less government regulation in a number of ways. And so the question is, how can we use this private sector to mobilize funding going into the whole food systems? And so what policies do we need to incentivize to reduce the constraints, to support innovations, and of course also to ensure a fair distribution of revenue from these systems? How can we have equity and efficiency going together? I'm going to stop here because I'm going to make sure that there's enough time for the people to present. I should not forget, I put a big note here, if series on financing the food system transformation. Okay, and so the whole idea is to address the types of questions which I just briefly reviewed, which we will talk about today. And it's an open blog series, so that means we welcome contributions from people outside our organizations who have interesting things to say, and maybe some of the presentations here today will fit well into that thing. So with that, thank you very much.
Thank you. Thank you. Thank you, Jo. Thank you, Jo. Lita, it's your turn.
Thank you very much. I think you did an excellent job in the pronunciation of the difficult name. So that's an A for you. Thank you very much. And thank you to all for this opportunity to say just a few words. And as the DG said, the keynote is still coming. It's what we are about to hear. I just want to take the opportunity to greet everyone once again and express our pleasure in being invited to say just make a few comments and observations on this very important subject. We are very privileged, of course, as the Agricultural Research Council to also have been invited as a member of the Sub-Saharan Africa constituency of the CG System Council. So we are looking forward to the opportunity to work even more closely with the CG system and contribute to some of the programs. And I've been seeing a number of people here that we were with recently when we hosted the meeting of agricultural chief scientists as part of the G20 presidency of South Africa, which was really a very successful undertaking, which gave us a communique that was really a struggle over the last meetings of agricultural chief scientists, as many of you will know, in the room, in the last 3 MEX meetings. But to the business of today very briefly. Of course, to address global food insecurity and malnutrition, we talk about transforming how food is sustainably produced, distributed, consumed. And of course, this is in alignment with the SDGs and Africa's Agenda 2063 in the context of Africa. Within the African context, and indeed globally, financing of food systems transformation, and this is like many other regions, is competing with a number of priorities. And we have seen now the rise of demands on resources for defense and security and other things. And we see it in terms of the funding of some of the programs that relied on some of the first world countries in terms of research programs, where those resources are now being directed to some of these competing priorities in real time. It's no longer something that is going to happen in future. We are already experiencing it. But there are a whole lot of other, circumstances and, and a number of issues that inform some of the decisions that we see influencing some of the financing that we would like to see going into science and technology, particularly on agricultural science and technology, which the DG has described very well as flatlining of the trends in financing. I think a few of them is, of course, the long time lag that is between the beginning of a research program and the time where we get a technology that can indeed be used in the food system, can be something that is tangible, that whether we're talking about a methodology or whether we're talking about a specific cultivar development that can withstand some of the challenges that we now deal with when it comes to climate change, whether we're talking about increasing of yields, etc. These things take time. And this is particularly the case for crop breeding programs, for instance, where you expect these things to happen. I noted that there is a few spillovers from the discussion that just ended with what we're talking about, the discussion from capital markets perspective, because the commercialization of agricultural technologies as we speak leaves a lot of room for improvement. There are a number of opportunities that are not exploited fully. And I think even in our own case, as the Agricultural Research Council, we do feel that there is a lot of room to move beyond where we are in terms of how we commercialize the approximately 400 registered plant breeders' rights that we have in our portfolio. And of course, all of us, and I was happy to hear from the colleagues from TIA that are talking about some of the work that is being done in South Africa, and TIA is one of our partners in terms of commercialization of some of the technologies that we develop within the ARC. But thirdly, I want to wrap up quickly because the keynotes are still coming. Some of the outputs, of course, from our research and innovation efforts are aimed to deliver public good benefits. And so from an investment perspective, this becomes an issue. And so we've seen in a number of research organizations really jacking up the commercialization part of the story. And we are also moving in that direction because, particularly from publicly funded research, because you struggle to work very easily with the private sector. Private sector want to know exactly what the output is going to be and what the returns are going to be in in how long. And so the public good part of it is going to be difficult. However, it's not all doom and gloom. We actually have a number of examples, but in the interest of time, I may not go into all of them, where we've looked at the return for each dollar that we have invested in some of the breeding programs, which exceed the return, the investment, 10, 20, 30 times. So investment in agriculture, science, and technology for food system transformation is actually a real business with very real returns. But we have to be very focused in terms of what it is that we are looking for. So I want to pause here on that note because we have a short day, and I look forward to hearing all the other examples, and we will obviously have perhaps another opportunity to share a little bit more on this. Thank you very much for the opportunity.
Thank you, Letha, and thank you, Yo, again for setting the stage of today's conversation. Now, let's move to the first session of this event, which is actually about the state of CGIAR research and its centers. So please welcome here on stage some representative. Yes, come here, and I'll introduce you. Okay. So, yeah, good. So we have James Thurlow, who is the director of the Foresight and Policy Model Unit at IFPRI. Welcome, James. Then Ruth Hill, she's the director of the Markets, Trade and Institution Unit at IFPRI. And then Godefroy Grosjean is the co-lead of the CGIAR CEAT Hub for Sustainable Finance. Welcome, Ho. I think, James, you're going to be the first one speaking. Thank you. And
we're going to use the safety of the lecture. So we're going to, I'm going to keep on the same vein of talking about public finance. I know a lot of the discussion is going to be about private finance. But if you think about what I was thinking about, and I mean, the one thing that every single government in the world has in common, right, regardless of whether they come from a rich country, whether they come from a poor country, every government has in common the fact that their budgets are constrained, right? And that means that trade-offs, those are policy trade-offs, those are inevitable, right? That difficult decision of deciding what to invest in and what not to invest in, those difficult decisions, those are unavoidable. Now, I come from a small group in the CGIAR that use economic models to help governments decide how to prioritize their investment plans. And so, what we've been doing this for quite some time now, and I think there are two things that we think are more important today than ever before, right? More important today because of our more constrained financing environment. And so I'm going to talk about those two things. The first thing is I think that we need to put, or we feel that increasingly convinced that we need to put cost effectiveness at the heart of our decision-making process. And that doesn't sound very controversial, but in reality, it's actually quite difficult to do. So if you just look at the research that we do, a lot of the time we focus our efforts in trying to measure benefits as accurately as possible. But if you're going to do prioritization, right, you also need information on costs. It's not enough for an investment just to be beneficial, it has to be cost effective. So our team spends a lot of time working with ministries of agriculture, particularly in Africa, helping them prioritize their agricultural investment plans. And governments are very open to this cost effectiveness analysis. So just last year, Rwanda, Tanzania, they launched their new agricultural investment plans, and both of them include information that we had developed together with the ministry on where the highest returns to investments were. But more excitingly, right, thanks to funding from the US government, from the United Arab Emirates, and from the Gates Foundation, we've been able to start a large-scale multi-country study where we are systematically measuring and comparing the cost effectiveness of 18 different core investment areas, right? Different investments in different parts of the agri-food system and at different points of time out into the future. And now that we've finished about 10, 12 of these different studies, we can step back and we can start to look for the patterns that are starting to emerge from these studies. Or I should mention, they're all coming out of Africa, right? So I'm going to highlight 3 different lessons that we've learned that I think are important. So the first one is that for a very long time, we have emphasized the importance of staple food crops. And it is true that cereals, root crops, these are very effective at reducing food insecurity. Think hunger, undernourishment, and so on. But when we do our analysis, we're finding that if you're interested in poverty reduction, if you're interested in job creation or improving diets, if those are your outcome interests, then often it is fruits and it is vegetables and even cash crops that can be far more effective at driving those outcomes. And that's difficult for us as the CGIAR to internalize, and it's difficult for ministries of agriculture as well. So that's the first lesson. The second lesson is that we know that smallholder farmers are often amongst the poorest of the constituents, the poorest populations in the countries where we work. And so it would seem obvious then that investing in smallholder agriculture is the most cost-effective way of driving down poverty. But what we're finding in country after country is that actually investing in those downstream processing and small-scale trading are often far more cost-effective because those downstream sectors open up new income opportunities for smallholder farmers and so on. Another difficult lesson for us to internalize within the CGIAR and with our ministries of agriculture who we work with. And the third lesson, and Ruth is going to talk more about this, but a lot of the budgets that we're working with, they're focusing either very heavily on short-term interventions, think cash and subsidies, or very long-term interventions like agricultural R&D. But what we're finding from these studies is time and again, the most cost-effective investments are in those midstream farmer-facing services. Think extension, microfinance, and so on. And the reason why they're more cost-effective is because they help farmers adopt the technologies we already have, as opposed to investing in new technologies that may not necessarily make it into the field, right? So those are just 3 lessons. And you can see that in order to learn those lessons and actually implement them, we would have to shift some of the priorities that we've held for a very long time. And that's difficult for us to do, right? It's difficult for us to hear. It's also difficult for us to implement. So that's the first lesson, cost effectiveness. The second is, and we're increasingly, this is a somewhat new finding in a sense, but it's one that we're increasingly think is going to be important in the future, and that is that food systems are going to have to, agri-food systems are going to have to increasingly shoulder the costs of their own investments, right? That it's not enough for an investment to be cost effective, or just being cost effective doesn't necessarily make an investment affordable. So our group is spending a lot of time working with different ministries of finance, and they're asking us to model their tax reforms and help them broaden the tax base. And we're hearing loud and clear that it's very difficult to motivate for agricultural investments when we know that the growth that comes from those investments don't always generate the revenues needed to sustain the investments, right? So we have for a long time told governments, you can't afford not to invest in food systems because of all the social goods that come out of it. But we need to shift our mind and help governments understand that how they can afford to invest in agri-food systems. We don't like the idea of taxing smallholder agriculture and rural populations, but maybe those downstream food sectors, the processing and so on, maybe there's an opportunity to find the revenues that are needed to make these investments more sustainable. So those are our 2 lessons. We need to emphasize cost effectiveness, and as uncomfortable as it is, we need to start thinking about agriculture as a revenue generator. Thanks very much.
Thank you very much. So I'm going to really pick up where James left off and talk about one type of spending that we see, that James mentioned, that we see being widely present in a lot of budgets, particularly on agricultural budgets, which is spending on subsidies. So if we think about globally, and we think about spending on subsidies globally on agriculture and on energy subsidies, the amount that is spent globally is a very large number, $1.25 trillion annually. And not only do we see this being a very large number globally, but we see that in every country in the world, subsidies take up 2 to 3% of GDP in terms of public spending. And this is true. So we see, if we look at fiscal systems across countries, they vary a lot between high income, middle income, and low income countries. The one fact that is constant across all income levels is the share of GDP that is spent on subsidies. It's quite striking. And so when we think about spending, it's important to take a good look at this. Is this optimal? Is this optimal that we're spending 2 to 3% of GDP in each country on subsidies? And in particular today, with the focus of our session being particularly on agriculture, I'm going to talk specifically about some of the work that we've been doing on input subsidies, which is a very large share of subsidy spending, particularly in the countries where we're working. So it's a very relevant for a lot of for the sorts of work that James was talking about. So we know that these subsidies are put in place to address critical challenges, but their scale and an increasing body of evidence leads us to need to sort of answer 3 questions about them. First, is this an effective expenditure? Does this pass the cost effectiveness criteria that James was speaking about? Does it get us to the sorts of impact that we want to see? If not, is it realistic to repurpose these funds? And if yes, what can we repurpose these funds to? So I'm just going to look at these 3 questions in the few minutes that we have and some of the evidence we have. So, and the first question is sort of, is this an effective expenditure? This is not a new area of literature. There's been a lot of evidence on this, but increasingly, there's more and more evidence pointing to the fact that these are not really probably your highest return investments. Subsidies, we know they distort incentives. They are often put in place to encourage increased use of fertilizer, but they result often in fertilizer being overused or the wrong types of fertilizer being used for the soils that are present. And it can also result in over-intensification, overcropping of fertilizer-thirsty crops as well. So it affects the crop choice also. So this is really distorting production when we have these subsidies in place, and it can bring long-term soil health and sustainability challenges as a result. We also know that when we look at these subsidies, that they are what you would call a regressive form of spending, in that the largest share of spending on these subsidies is not going to poorer households, it's going to better off households. So yes, some of these benefits of subsidies do reach poorer households, but the majority of spending, in most cases about 60% of spending on these subsidies, is going to households in the top of the income distribution. It varies depending on how the scheme is designed in each country. But for sure, this is not really getting us to sort of greater equity in terms of how finances are being spent. We also know that in a lot of cases that the way these subsidies are implemented and the government procurement that's associated with them can have quite distortive effects on agricultural markets, on agricultural input markets in particular, can really constrain the development of these markets and stifle innovation and market responsiveness. So it seems that the evidence to that first question says, no, we can do better. This is not passing our cost effectiveness test. When we look at the marginal value of these funds, you want this number to be much higher than 1, and often it's less than 1. So this is not always, what we should be spending our money on. So can we repurpose these funds? Is this a fantastic source of, hidden pot of gold that was actually under our chair the whole time that we can use to fund some of the things that we'd like to be seeing taking place in the ag-food system? Well, I think before we get to that, it's important to think about, well, why, first of all, is money spent on subsidies? Especially given we know they might not be as effective as we might hope. And it's because they do have 3 attractive features. They offer immediate benefits, so they increase productivity right away. They offer a tangible benefit to farmers that farmers know they're getting from their government, and they're, for that reason, very politically popular. It's a good way for a government to show support to their farming community. And thirdly, relative to some of the other sorts of interventions that in this space, such as extension services, microfinance that James was mentioning, these are relatively simple to implement. A subsidy scheme is quite easy to put in place, to scale up. Scaling up extension is much harder. You have to train a cadre of extension workers. get them out and, with new material ready to train farmers. That's much harder. So these three features, the fact that they're quick, they're popular with farmers, and that they're easy to implement, result in them being done over and over again. So if we're going to repurpose this money, we need to think of investments that have those characteristics also. Yes, they're going to be more transformative, but they also need to be having these characteristics too. So the answer here is, yes, we can repurpose, but we probably can't take this money and put it into ag R&D. That's a very long run return. That's going to be a hard sell. We probably can, as I mentioned, take it and put it into extension. So what can we do with it? How can we make sure that this money that's going on subsidies gets us closer to the sort of transformative ag food system that we want to see and work towards? Well, I'm going to highlight 4 examples of things that we know that are transformative, they're high return, they're meeting environmental goals, and they do have these 3 characteristics of being relatively easy to implement, something tangible for farmers to see they're getting from their government, and fairly immediate. So the first one is, and this is something that we're doing more and more work on in the policy program of the CGIAR, in the work that we do to try and build the evidence base on what kind of investments can we talk about? How can we do innovative policy subsidy reform? So the first one is digital advisory services. Providing farmers with timely and accurate information to optimize their practices. This is something that can be implemented relatively quickly, effectively. We see, for example, in Nigeria, that the digital delivery of personalized extension increased farmer profits by 10%. This is a good number. Secondly, subsidizing soil testing and soil investments. Promoting sustainable soil management to ensure long-term productivity. An example here is in Tanzania. Maize farmers were provided with low-cost soil testing that they tested their soils with, and then customized input recommendations and a voucher to pay for those inputs. And they saw a 70% increase in maize yields. Third, payment for ecosystem services. So sometimes the sorts of investments that are needed in soil health and land management are not going to bring a return immediately, and there needs to be some payment to a farmer in that immediate year or 2 of investment so they can see a return. In Ethiopia, cash transfers to households for investing in land management saw tree cover increase by 5% and productivity increased by 5%. But importantly, productivity increased more in cases where there were droughts. So this was an investment that was also reducing vulnerability for farmers, vulnerability to droughts. Small-scale irrigation is another area where we see high returns when it can be implemented, but this is often constrained by lack of access to long-run finance. So here's some examples. There's more examples we could talk about. I know I'm at time. To say that, it is important to think about how we spend the resources that we already have going to the agricultural sector wisely, that we need to also be wise about how we think about repurposing. This isn't going to solve all of our investment needs in food systems. There's still going to be a need for public investment funds into long-run, high-return investments such as ag R&D, roads to markets, etc. And there's also a big need for bringing in more private sector funding to finance other investments that farmers and other actors in food systems needs to make. And this is something that my colleague Godfrey is going to speak about now. Thank you.
Thanks. So good afternoon, everyone, and thank you very much to the colleagues before who presented. Actually, I will complement the presentation from my colleagues who really showcase work the CGIAR is doing in terms of advising public sector in designing investment into the sector. What we do within Impact SF, so CGIAR Hub for Sustainable Finance, is actually connect our science from within the CGIAR to the needs of investors who want to deploy capital in food and ag sustainably. So we set up a unit, I think 4 years ago, together with Richard, who was there as well, really for that purpose. And we organize our activities, I would say, around 3 key pillars. One is work we do with asset managers or fund managers. So far we're working with around 6 to 7 funds. Essentially, the idea is really to bring science from what we say from end to end. And what we mean by that is we usually come in co-design investment vehicles with different investment strategies, geography focus, and support the asset managers in identifying effective investment strategies from an impact point of view. And then also bring science in the due diligence processes, understanding better the risk, impact an investment can generate. And then further down the line, when the investment fund is operational, we come in and support in terms of monitoring, reporting, and verification. So that's one area. The second area that we work with is really with banks and financial institutions. So supporting banks better understand the risk in investing or lending to the agriculture sector, and then helping them design loan products that respond to the specific risk. But I come back to that in a second. And then we also work on pipeline development. One of the key issues we hear over and over from many investors is there is a lack of bankable pipeline. So what we do is through our networks, through our work on the ground, we identify agri-SMEs, actors across the ag sector, and help them integrate climate in their strategy and become more bankable, and then eventually link that with some of the investors we work with. Now, so that's a bit, the picture of what we do, but I also want to, I don't want to be doing a marketing pitch here, but just actually identify some lessons learned from that work that could be useful for the discussion, and hopefully, start some of the discussions we will have later with the great panel that we will have afterwards. So, working with funds and asset managers, I see few lessons learned and from our experience in the last few years. One is, well, there is definitely a momentum in an interest in investing into food and ag sector. When we started, engaging as CG with asset managers in 2019, when we were talking about investing in ag, it was not really like a big priority, right? And I see this has changed, and there is a significant interest from investors to go into the sector. Now, one of the challenges is that we see that a lot of the investment vehicles that target the sector, they are blended finance vehicles that to a great extent still rely on public financing, right? And the big question, and maybe the $1 million question is, how can we transition from that status quo towards having much more commercial and institutional investors going into the sector, because they are the ones who have the ability to bring much bigger pools of capital and the type of capital we need for the sectors to transition. And I think here there are two key things that are really needed. One is benchmarking. There needs to be a better understanding of, what is the effective level of first loss or catalytic capital that you need in a fund to maximize the leverage you get from additional private investors. Because public investors is often needed, but it shouldn't be there to subsidize, the private sector. So we need to find the right balance for that, and for this we need better benchmarking. Also, better understand what are the sort of risk-return impact ratio that can be expected for different types of investment strategies, different investor profiles. At the moment, the benchmarking doesn't really exist, right? So for investors, it's difficult to compare really different funds from that point of view. Second, we need standards, and especially to find ways to reduce standards and standardization, and find ways to reduce the transaction cost linked to transactions. It's still very costly to invest into the sector. And for instance, in the area we work with, in terms of impact, of risk assessment, impact assessment, before it was a lot of, almost very ad hoc work and so on. And what we've been doing over the past years is really to use CGIAR science to really facilitate risk assessment, impact reporting. For instance, we're working with a fund of funds, which is called FASA, which stands for Financing Agri-SMEs in Africa. And we developed a whole reporting systems for funds to help them with limited data, assess the impact they generate through the investments, and then report on that in a more standardized fashion. So that's one way. Or for instance, with Agri3 Fund, we have been using a lot of remote sensing capabilities to better track what's happening on the ground and in a sense, reduce the cost compared to a situation where you have to go in each field and see what's happening. So that's lessons learned with funds. With the banking sector, I also think the banks need to play a key, banks and non-banking financial institutions like MFIs, they need to play a key role in financing the sector. And why is that? Is that they have the ability to lend to very different types of investee profiles. Right? They can give loans to smaller farmers, like an MFI. They can give loans to big agri-SMEs. And in that sense, they're quite unique, this ability to give loans to many actors. And also some actors that may be too small for impact investment funds. So to mobilize capital at scale, we need to go as well through the banking sector. So that's one of the routes I think that is quite promising. But as we all know, banks, so the question is why it's not happening, right? And the reality is that banks tend to be maybe risk averse or to perceive agriculture as a very risky sector, right? So again, there, I think as an institution, as a CG, we have a role to play to help them better have access to better data in terms of assessing risk, but understand the risk across their portfolio. But transform this, not looking at it from purely only from a risk point of view or risk management point of view, but also showing that there is a business opportunity that by better understanding the risk, you can also design new loan products that you bring to the market that help farmers, agri-SMEs manage the specific risks. So there is a business opportunity. And that's what we're doing in different regions, in Kenya, in ASEAN regions, in Ethiopia, for instance, working with banks, helping them review their portfolio, better understand the risks they're facing, and then design new credit products that they can bring to the market. And also help them in the reporting of the impact they generate to their activity. So in a nutshell, and I stop here, I think for us as a science organization, we have a role to play in bringing data and science-based solutions for managing risk and impact reporting and reducing the transaction costs of doing that, bring standards and benchmarking, as I was saying earlier, and really bring evidence to make sure and that goes back to some of the points that you made earlier, to make sure the investment, it's not only about mobilizing capital, but make sure it goes where it should go, right? To have the right impact that we want to have, and generate the right transformation in the agriculture sector in the future. So thank you very much, and looking forward to the discussion.
Thank you Godefroy, Ruth, and James. Now let's move to the second part of the event, which is more focused on the private sector, actually. And I'd like to call in Clemens Bresinger, who is going to walk you through this part and is going to moderate the session as well. Clemens is, let me introduce you very briefly, he's the program leader of Kenyan Strategy Support Program and Senior Researcher Fellow for Development Strategies and Governance Unit at IFPRI. So welcome on stage, and I'll leave you the floor. And okay, I think you can use that one. Yeah.
All right, welcome everyone. Good afternoon. We have come a long way in this session. We had some big picture introductory remarks on the difficult and challenging and interesting times that we're living in. Important role of science. We covered a lot about the private sector, and now we are transitioning into impact investment as a promising avenue for food system transformation. So for that, we have a really exciting panel, and I would like the panelists to please come forward, all of you, and take a seat. And while you do that, I will introduce you. Dennis, please also come. And then Royal and Sylvain. Yeah, here we go. All right, so what we try to do here is, I'll have a question for each of them, but then we want to engage with you. So get ready for your questions so that we'll be having very interactive session. So ladies first. Dennis, pleasure to have you here. Dennis is CEO and Managing Director of AGRI3 Fund. She will tell us a little bit more about the fund, but her mission is really to build bridges between financial institutions, governments, and businesses to transform the future of agriculture. So my first question, Dennis, to you is, financial institutions and banks have to play a key role in this, yet they are not always very engaged. Why not? And what is AGRI3 Food doing to get them more engaged?
That's a very big question. It can take several minutes to respond to, but I'll keep it brief. Very nice to meet you all. I'm Deniz Sarıt, head of AGRI3 Fund. We're a blended finance vehicle focused entirely on agri-food systems transition in emerging markets. We're 5 years old, based in the Netherlands. Our anchor investor is the Dutch government, and we're supported by the European Commission, the Swiss community, the Global Environment Facility, and some commercial investors. Now, the idea behind AGRI3, and IDH is a delivery partner who's supporting us on the technical assistance. The idea around AGRI3 was initiated 5 years ago, where it was very much focused on what we already heard today. Climate finance is not going into where it should go in the agri-food value chains, although it could be a critical part of the solution. How can we change that? AGRI3 is an interesting project because when we talk about blended finance, which was obviously a term coined by the SDGs, launch of the SDGs, AGRI3 wanted to experiment around blended finance in 2 ways. So our fund capital structure is a blended finance structure. Very, very, very typical version of it. We have government money in our riskiest tranches of the capital stack that is really there to absorb losses, to encourage the private sector to do more. And then on our capital stack, on the top of our capital stack, we have institutional money. So when we look at blending, it's also important to understand that the capital markets is a value chain as well. So you have asset owners, you have asset managers, then you have banks and corporates, and everybody participates in this capital markets, global capital markets. So what we're trying to do in our fund is to make sure that we are attractive to the institutional capital who's concerned about the transition of agri-food systems, mainly for macro reasons, right? And then on the asset side, on the project side, we're blending banks and other asset managers who are trying to set up strategies and deploy capital into solutions. So in a sense, it's I always see it as the 2 sides of the same coin. In the one end, we're trying to bring a mechanism to the market that sort of helps them to green finance. So when they allocate capital, they can already think about the climate risks, the biodiversity risks, and the solutions. And on the other hand, we're creating products, which is our guarantee, where we are helping banks to finance the green projects. And that they too obviously support each other. Now, what are the people concerned mainly about, and what's driving the agenda behind this? I mean, fast forward 5 years, today there's still the gap. The money is not flowing fast enough. But what is clearly changing is that the interest is there and the projects are there. Often when we speak in the emerging market context, we always say, look, the projects are great. The projects will stand on their own feet. They just happen to be in difficult markets. So you need to get your head around different kinds of risks to put your money behind it. And then what's systemically, I think, driving a lot of enthusiasm around these topics is mainly in the banking world, with the Task Force for Climate-Related Financial Disclosures, now TNFD, Task Force for Nature-Related Disclosures, Financial Disclosures. Once the financial ecosystem is able to measure risk and understand risk, That's the first step. Then comes the innovation, and that comes the capital allocation strategies, and then comes the solution. So we're seeing already that happening in climate, and I strongly believe what TCFD and climate risk triggered in renewables investment, TNFD will hopefully end up being the same for food and ag investments in the future. We just need to understand it a little bit better.
Okay, wonderful. Yeah, this was a great first round. Very good. Now let's move on to Royal Messi. He is the CEO of IDH Investment Management and also the Chief Executive Officer of IDH Investment Management. So again, blended finance is the overall topic here, and sort of similar question to you. What are the challenges for an impact investor to invest in food and agriculture these days, and in particular when it comes to funding smallholder farmers and reaching them?
Well, let me start there and talk out of experience of the last 5 years. Well, my name is Roel Messi. I'm the CEO of IDH Investment Management. Thanks. We manage a fund called the FarmFit Fund. We started that in 2019 with a vision that smallholder farmers should be an asset class. Obviously, that sounds like a dreamer. We're very far from that. But however, our vision was, let's de-risk other actors into this sector by applying different type of instruments and demonstrate which smallholder farmer-based business models work and which not. And the promise was to deliver a slight positive return to our investors. Our investors are also, for us, we have the same anchor investor, which is the Dutch Ministry of Foreign Affairs. However, our senior investors are a little bit different than Agri3. We have 2 large food companies, one coffee company is called JDE Peet's. It's the largest roaster in the world. We have Mondelez, well known from the Oreo cookies, and we have 2 financial institutions, being FMO, the Dutch Development Bank, as well as Rabobank. Let's say the challenge was to bring the agendas of all these very different players together with one common goal. The instruments we have, we invest with, basically the idea is we take more risk so they have less risk. So that means that we invest with subordinated loans, mezzanine financing, guarantees to some extent, and also equity. Our assumptions, we had 2 assumptions which were quite based on experiences in the past. One was that value chain actors, like for instance, coffee traders or maybe input providers, could play a very significant role, and because they connect, of course, the brands to what's happening on farm. We had one pilot transaction with Neumann Coffee prior to launching the fund. It was very successful. And we thought, okay, now we're going to replicate that. Everybody will be super excited about it, and that was also true. The same thing about local banks. We cannot solve this without banks getting involved and bringing the capital to the field that is so needed. Those 2 assumptions proved to be completely wrong. One, let's say on the trader side, the value chain actors, yes, they are interested, but it's extremely complex for a value chain actor to implement a farmer financing scheme. Of course, also risk plays a role, but operational part is predominant there. Then looking at the financial sector, obviously we could engage with players like FMO and Rabo at this part of the world. But locally, it's a different story. And I think Godfrey already alluded to that, is that what we have seen, I would say there are two things that are big hurdles. One, of course, is the alternative investment opportunities. Why do something extremely difficult, operationally complex, with more risk, when you can invest in government bonds, or maybe you can invest in larger corporates? So we brought to the market, to give you an example, we could bring 30% cash collateral. But then often was, yeah, but still we have to apply our full collateral policy, which would basically disregard your 30%. And so, let's say the agri-SMEs that we would be focusing on and would be the interface to the farmer, would still have to come up with the same type of collateral. So then I come to the second point, which is basically the banker's mind. I haven't been a banker myself. It's not being maybe too insulting, but it's really difficult to get away from that. So then you would think, okay, then the Farm Fit Fund would become a complete failure while these important assumptions prove to be wrong. Well, not entirely. It's actually doing quite well because the framework that we set ourselves is broad and focusing on reaching, well, we said we want to reach more than 3 million farmers and improving their income by 50%. Well, the 50% is actually it was a bit loose to put an objective like that. But the farmer reach we will make, and also will make in a meaningful way. So it's not just only light touch. So that's one. We started to basically have our strategy based on 3 verticals. One, which we call archetypes. One we would call agribusiness driven. Second is financial institution driven, and 3 is innovation driven. Innovation, talking about technologies that are really transformative. Also, that is our equity portfolio, which in this instance mainly is in India. And maybe you say, okay, India is maybe easy. It's not. Why? Of course, there are a lot of smallholder farmers in India, but the attraction of that is also that we see models there that can be replicated to Africa. So that I think we're quite excited about. On the financial institutions bucket, we moved more to MFIs and to fintechs. And on the agribusiness side, yes, we've done some business with commodity traders, but more with agri-SMEs. So that all went reasonably well. However, the challenges continue to exist, right? Because getting financial institutions, large local financial institutions to invest, indeed requires better understanding of, well, actually it would apply to all kinds of investors along, let's say, your supply chain, the financial supply chain. It's understanding risk in a very quantified way, because that's basically the basis of everything. And it also means that we have to be more transparent, develop common learning agendas, learning reporting frameworks. So basically a basis on which investors can rely, which can then scale.
All right, thank you very much for shedding light on not only the challenges, but some of the innovative solutions that you're coming up. That's exciting. Okay, so let's now move on to Sylvain Goupil, Octobre, Le Printemps des Terres, and Restore founder and managing director. Very welcome. A bit of a similar question to you. The blended finance is not a really new tool, yet it's still out there. So what innovative solutions do you have to sort of transition this to a more sustainable private sector driven endeavor?
Yeah, thank you so much. I think there are mainly 2 innovations. The first one is on the funding structure by itself, and I will develop that a little bit. And the second one is climate finance and payment for custom services, but much more than climate, going beyond climate. And maybe we have time to develop that. But on the first one, and back to the initial question, which is impact finance, and how can we basically, what is impact finance and how can it fund the food transition? Something very funny about impact finance is about 60% of the funding is coming from concessional sources, being DFIs or foundations, and only 1/3 of this money is coming from the private sector. And so you're talking of blending, which is providing first loss guarantees by government, mostly to cover the risk of DFIs, which is a little bit strange. You know, it's like government covering government risk. And so it's not really catalytic in the end. So blending is great, but what you really need is to mobilize private capital into this space. And then by experience, blending again is great, but the reality is that to implement a blended finance structure is taking forever. It's taking years. It's taking 2 years, 3 years, 4 years. It's taking so much time that quite often private investors are saying, oh guys, you know, well, it's a great structure that you're having, it's very complex, a lot of risk, first loss risk taking off and so on, but basically come back when you have the first loss secured. And come back in 2 years, come back in 3 years. And after 2 years, you come back to the guy has changed job. And so you have to explain to the next guy. And it's taking forever. And you know, honestly, blended, again, is great. But it's a nightmare to implement and to operate. And it's not that catalytic, again, because if you look at impact finance, 2/3 of the money is public or quasi-public. So it's not a failure, but it's not a great success either. One of the solutions that we have developed at October is to look at the other way around. It's because blend finance is about taking off some credit risk, so reducing the credit risk, so the risk of loss, when actually the private sector is quite aware about risk taking. One risk they cannot take is the liquidity risk, is basically how much time I will be stuck with my investment, and can I exit my investment very quickly? And if you look at the financial markets today, about 90% of the private asset under management are allocated to liquid assets, so listed bonds, listed equities, you know, listed products and so on, whereby investors can exit within, you know, 1 day, 2 days, 3 days. So actually the big risk when they are considering investing into impact funds is not too much the credit risk, which is, okay, I'm going to lose 20%, 30% and so on. The big risk for them is to be stuck for 8 years or 10 years. And now we're talking about evergreen fund of 20 years, which is passion capital, which is really needed on the ground. But the reality is that the private sector is not structured to take this kind of risk. So basically what October is doing is looking at this risk differently and trying to provide liquidity solutions, a little bit like a central bank would do. You know, central banks in the end are designed to take, you know, the last resort risk and to be able to provide liquidity to market when the market are basically squeezed. And so by providing liquidity, that's a big way to enable private capital to say, okay, you know what, now I know investing into food chain transformation is difficult and risky, but you know, if I can put my money and exit within 2 years if I don't like it, then the risk is much more acceptable for them, So that's really what we're trying to do, try to take a step back and not addressing the credit risk, but the liquidity risk with the support of the European Commission.
Yeah, liquidity obviously is a key factor here. So thanks for this first round. I wanted to make this a bit more interactive. You can also maybe ask the presenters from before, more the public sector sort of perspective. Our panelists here, do you guys have any questions at this point? Yo, please go ahead.
Thanks very much, and congratulations to all the presenters. I thought it was very clear and a wide variety of issues. Roel, yes, I have a very specific question for you. You mentioned that your first assumption was that you would work through value chain actors like traders, and then you said that was wrong, but your strategy now, one of the pillars is working through agribusiness, including agri-SMEs. Isn't that the same?
No, it's not. Maybe it's just a definition question. It's international commodity traders, like the ecoms and the olams of this world, as opposed to local agribusinesses, which can be traders as well. We financed a large grain trading business in Zambia, for instance. Quite a nice scale, financing a transition from large-scale sourcing from large-scale farms to smallholder farmers. So these are the type of things that we started targeting. And yes, we did a few we did one transaction with Ecom. But it is just too difficult for them to, and they would like to leave the financing part, the farmer financing part, to others. So like fintechs or MFIs.
So the large one didn't work, but the small ones work.
Yeah, on a local level it does work. And one thing that is important to understand is that these organizations are very decentral. So basically all the country managers, and they have a lot, they all are responsible for their own P&L. And meaning that when the CEO of the company asks, we're going to do this farmer financing, then the local country director thinks, yeah, that's very nice, but I can maybe deploy 1 million in my country. I will never make that profitable, and it creates a lot of headache for me. And sometimes, when there's a large scale, like a large country with lots of farmers, we've also seen, for instance, what IDH is. And IDH, I mean more the NGO, worked on climate resilience with coffee farmers in Vietnam, and then the financing became part of that. And there was also TA involved, so then you can make it work. But on an international basis, setting up a facility that you will finance farmers in 10 or 15 countries, it is challenging.
All right.
Sort of
Yeah,
add to
please go
that,
ahead.
the same logic, and therefore the problem applies to global food brands. Because some of them, I mean, in many of these value chains, it's super fragmented, nobody has vertical integration, traceability is an issue, and often the local CFOs or local operations call the shots rather than a globally driven strategy. And a lot of the activities sit in people's cost budgets as operational expense rather than investing into future resilience, investing into sustainability. So if we could change that by simply introducing an accounting standard, that would already be a long impact. And I think just as a similar experience, like we have the capital, we have the strategy, we know where we want the money to go to. It's actually how you get there is still what we are all trying to figure out. And Agri3 went through a similar experience over the past 5 years where we said, okay, we're very much focused on land use and land use change and preventing deforestation. So what is the logical place to start? We're gonna only go and work directly with primary producers. And then that works in Brazil because you have very large landowners, right? But when you start going into Africa, you realize 2 things. One, it's very difficult to reach primary producers, let alone, the infrastructure is not there, finance is not there. But also, they're not the problem. Like if you want to solve deforestation in Africa, you actually need to solve the food loss rather than intensifying production. So you find like different causes and solutions, and then you iterate as you go.
All right, let's take, would you like to add, or shall we move to the next round? Let's take 2 or 3 more questions. Next one is here. Please introduce yourself.
Yes. Reyes Tirado from Climate Bonds Initiative. Thank you, very interesting panel. So in Climate Bonds, we develop standards for bonds, but also for other label debt. And we have been developing criteria for agri-food systems. My question is, so we have these global standards, climate bonds and other, but then we often hear that investors, we often hear that we need more contextualization at the local level because food is special and agri-food systems are very special and very context dependent. At the same time, we need this global focus. So my question to you is, where do you feel this nice balance between global focus, parameters and standards, and how local do we go? And what are your tips in terms of how can we be more helpful? What do we need to develop so that really the capital is going to flow to these systems? Thank you.
Thank you very much. Let's take 1 or 2 more questions, if you don't mind. There's one more here.
Okay, thank you. My name is Petronella, and I'm with the Agricultural Research Council. I have a question for James. The finding that you say staple food crops are not an effective strategy for investments and staple food crops are not an effective strategy for poverty alleviation. I'm just trying to understand that within the context where very often for very poor households, just being able to afford a bag of maize for the month makes a big difference. And then you also compare how much they spend as a proportion of the income on buying the basic food commodities. And then you look at the volatility of markets. I'm just a bit concerned that if our governments were indeed to go in this direction, what would be the impact on our people? Thanks.
Good afternoon, and thank you so much for the presentations and the inputs from the various stakeholders. I'm Nompumele Loboko from South Africa. I just wanted to check, this is something that has really been bothering me, but having an interest, especially in the area of intellectual property. And just to understand how can agricultural research councils leverage IP as an asset, to ensure that it attracts sustainable financing and understanding or ensuring that there's still a good balance, with the research outputs as a public good so that it can be accessible to farmers. Thank you.
All right, so over to you. We have a bunch of questions here. Who would like to start? Well, you can for yourself.
Before I answer a question. I'm just wondering, so I can't remember, I think everybody at some point said something about understanding risk is the crucial first step. I think that was a quote, yeah. And I'm just wondering what type of risk? And I think your distinction between large commercial farms, as a South African, we know the distinction quite well. Large commercial farms versus small, what kind of risk are you, I mean, obviously it's risk in its entirety, but what kind of risk are you most worried? Because there's external risk, like what happens if markets collapse or prices shift or input supply chains are disrupted. And then there's the risk of the farmer themselves being a good business person or an entrepreneurial risk. And I'm just wondering, sort of, what are you seeing as the key source of risk that you worry about the most? Or maybe it's just both, yeah.
I can start with combining with the CBI question and data and risk question, just to categorize a little bit. So CBI, first of all, I have huge respect for the organization. We use your framework. Our own framework is based on your framework. And we find it incredibly important because we engage with the market, and market follows your standard as the taxonomy, right? Especially in the debt capital markets. Now, and I think what CBI has also gone through over the years is, what we realized, what is climate finance definition in food and ag, it was defined, but now we're trying to expand the scope of it, right, to be applicable to across the value chain and be a little bit more regional, context specific, etc. At the end of the day, I think the underlying problem is the availability of data, and what data, so that the finance world can translate that into their own use. So what does the finance world look? Typically, when it comes to agriculture, we need, obviously, information around whether one intervention is gonna work or not. So yield predictability. What does that look like? Then you have, obviously, externalities, which have huge impact on agriculture, like climate risk, fires, drought, hurricane, etc. Now we're talking about soil health. What does that mean? And all of that should lead to some sort of future scenario analysis that we can take as models or benchmarks. Finance world is very simple. All we look at is probability of default and the ability of that underlying business or project to be able to pay back the debt or their obligations if that default scenario happens to take place. So what is the capacity to undertake? So we look at operational factors, we look at technical factors. We've now started looking at external factors, and with the carbon and nature markets, we're also going to start having to look at the methodologies and what does that mean in terms of extra cash flow, how stable that cash flow is, and all of that stuff. And that's where I think the role of organizations like CGIAR are market shaping and shifting, because we will rely on your data. We won't rely on private data coming out of individual projects on a standalone basis. And finance world never wants to own the data. It's not never our data. We just want credible data that we can have access to so that we can embed that into our models.
Can I add something? I think fully agree with what you said, Denise. Adding a couple of things. Let's say all these risks, we can make a whole list, right? If you look at the primary production level, we all know them. However, what funds like ours are investing in are often agri-SMEs, and that adds another layer of risk. In a sense, you have governance risk, management risks. So all those risks that exist down there, let's say at the primary production, we need a company and management and a governance overseeing that can effectively do that. And that's where we see, I would say, most problems, most problems occurring. And that also makes me believe that in the end, when you can, that farmer financing in the end is less risky than agri-SME financing. Although it may be a bit counterintuitive, but suppose there are farmer portfolios that are being financed once they have matured and they have a track record. They have loss percentages, if all managed well. Of course, there are, maybe you know examples that are far worse, but what we've seen, it's possible. And if you create scale in there, and we also mentioned that already, is let's say a uniform credit assessment and data, then you actually have an asset which is not that risky. The only risk that really would come up, and that is a difficult nut to crack, that's foreign currency risk. So if you want to have, let's say, European or outside investors investing into this, this will then be the residual risk that is very hard to manage. And obviously also like crisis, agricultural crisis, weather crisis, that is also the other thing that may happen. And of course, then everybody thinks about insurance solutions, and they may work. Although so far we haven't seen so many that really are affordable and not destroying your investment case. But once you scale up, do it in a very efficient way, because the other thing, of course, that is really important, is an efficient and cheap way of delivery to the farmer or to the agri-SME, and in a very more standardized way.
Maybe just, it makes me think about something, a quick note, about the FX risk. The funny thing is that today, the capital which are invested into farming in Africa, for instance, are coming from Europe or the US, and so they're taking significant currency risk. And in these countries, you have a growing savings base, pension funds, insurance companies, and these insurance companies, when they have some money, some saving, they invest in Europe and in the US, and that's totally nuts. And so they're taking FX risk on the way out and on the way in. It's totally stupid. So what you would need to do is to, well, I don't know, educate or motivate or mobilize local saving, because that's a very potential and powerful tool to finance food transformation locally.
All right, we have covered a lot of ground. The staple crop question, James, he likes to be provocative, James, so now you have to explain.
No, okay. So firstly, it's not to say that staple food crops are not important for poor households. We're really talking, so, many value chains can be or many products can be very important for poor households. Many investments can generate positive returns. What we're looking at in this analysis is the relative rate of return across different investments. So staple food crops are definitely pro-poor. What we're finding though, 20 years ago, there was no question that investing in staple food crops like maize and what have you in Southern Africa, by far the most effective at reducing poverty. But that was back when a lot of farmers were subsistence farmers. So you had a direct line between what farmers were producing and what they were consuming. But things have changed now, right? Markets are more developed, farmers are more engaged, and so you can reduce poverty now by growing crops, cash crops, that are not even food crops, and you can reduce poverty by growing those crops. So firstly, my answer is, we're not saying that it's not pro-poor, we're just saying that there are more pro-poor options out there. Some of these higher value crops are actually turning out to generate more income for smallholder farmers and bring poverty down more effectively in some of the analysis that we're doing. And then the second thing is, and I think I mentioned this, the fact that maize and cereals and some of these other crops are crucial for reducing hunger, and I think you were describing some of the poorest of the poor. For those population groups, there's no doubt that the basic food staples are still the key avenue to improving their well-being. It's just maybe not enough to get people above the poverty line as a more sustainable livelihood strategy. Anyway, sorry, so that's a very long answer, but yeah, I should have qualified it. Yeah.
All right, Godfrey, you would like to add?
Yes, just a small point related to the questions from Reyes on the, the trade-off between, in a sense, standardization and context-specific. And I don't think there is really a trade-off in a certain sense, because there are aspects of the process that needs to be standardized from my point of view. And I gave an example from the reporting platform we are doing for FASA, right? There we developed a sort of qualification criteria and green list of potential business models that qualifies, under different impact themes, right? And that I think can be quite standardized. But then actually using CGIAR bases and AI, we're able to then move from there to quantify or use proxies that help quantify the impact all of these business models generate, but in a context-specific manner, because a certain type of business model or that qualifies as being green, let's say, won't necessarily have the same impact in West Africa versus India, right? And that's where you can use AI science to kind of, have context-specific data, but still standardize at the same time the sort of what qualifies and as a green business model. So we're trying to, to bridge the two.
All right, so have these guys done a good job in answering your questions? You are all happy? That is very good. So bravo, good job. Do we have any, before I let you go, any other questions? We have a few more minutes. If not, I would like to give you a minute or so, sort of as your punchline statement, before I think Debbie will invite us all for a drink. We have to do a bit more work here. I'm sorry. Are you ready? 1 minute each?
1 minute?
Or 1.5?
1.5. Okay. Now, I just want to answer your point on climate finance, which is a failure in the sense that you have 4% of climate finance allocated to agriculture, which is about 20% of emissions. The failure is not a market failure, it's a policy failure. It's when the global framework for carbon or climate have been designed, they excluded forestry and they excluded agriculture because it was non-permanent. And therefore, this policy failure went into a market failure and basically making agriculture an orphan for climate. What is now changing is the biodiversity angle with the GBF, which was signed in Montreal 2 years ago. And you can see that a bunch of policies are being implemented that are specifically dedicated to, I would say, forestry and ag, nature credits. And the European Commission is basically going to design a scheme in Europe just exactly to address this point. So in that case, that will be 90% of the money going to ag. And that's a very powerful leverage to transform the food chains.
I'll add up to that. I think we often speak on the same panel, the three of us, it's reality. But the audience often is finance world and representatives from corporates. Like, it's very hard, for us to be exposed to policymakers, scientists, R&D centers, etc. And today, when I was listening to the previous interventions, I was very positively surprised that we're actually all trying to look at it from a same angle, cost-benefit analysis, feasibility studies. Obviously, we have different definitions of what good looks like. and what outcomes we want. But essentially, it's the same economic modeling, right, we're talking about. How do we increase this engagement more? And that led me, when you talked about the frameworks around carbon and biodiversity markets, over the past couple of years, the policymakers and finance world have, in some shape or form, engaged around the just energy transition partnerships, right? Why don't we have something similar in ag, food and ag? You know, where you bring the policymakers, the development finance community to the private sector, pick countries, and then just go all hands on, you know?
Well, I want to build on that. We are part of all one big bubble because we all meet at these conferences and we all agree on the same topics, right? And it's like social media. You get, you know, supported in your own opinions, and it's also a danger. And so we have to get out of that. And now I want to make the point to large global brands who make net zero commitments, shift to regenerative agriculture. If you read annual reports, you know, you get a really warm feeling. And then I was part of an insetting course. I wanted to understand insetting much better. And then I asked the expert who was giving the course, you know, how much actually is taking place of this? And so let's say decarbonizing your value chain. Well, actually the answer is it's still so small. And that is, on one hand, it's a bit of a deception. On the other hand, it's also an encouragement just to push also beyond, let's say, your own circles.
Well, I also find this exciting. Now we bring public together, private sector, and what all unites us here is science. Now we like data, we like science, we like research, and I'm really happy to hear how the science, we know it informs policy, but it also helps private sector, impact investors. I think that's great, and I think we should continue this discussion and also move to some action. When you say sometimes we have difficulties getting in touch with policymakers, I think CGIAR has a very broad network, also very good relationships to policymakers. So I'd be happy to use that as one avenue to sort of continue and expand the collaboration. The return to science is always very high. Sometimes it takes a bit of time, but we should have that patience because the return is very high. So with that, I would like to thank you very much for being part of this event, also the previous panel, the organizers. Thank you very much for making this happen. And now I hand it back over to Debbie to have some good news for us.
Yeah. Thank you, Clemens. So yes, thank you all for attending today. It seems to have been quite a fruitful conversation. And since Clemens is eager to make you work a little bit more, we were thinking of joining us to a table outside for like a short drink and some more exchanges. So thank you so much.